Today, more pressure in the system as defaults rise and dividends are cut. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today, I want to look at the Nab results, which were reported today. Their first half 2019 results showed a statutory net profit of $2.69 billion, which was 9.3% lower compared with the second half 2018, but 4.3% higher than the first half 2018. Significantly, they dropped the dividend to 83 cents per share, a drop of 16.2% compared with the first half 2018, and this was more than anticipated by the market. But by the way, this is still an annualised dividend of circa 6.4% compared with CBA and ANZ, who are around 5.7%. And the cut in the dividend will help NAB build capital. The cash return on equity, excluding restructuring and customer remediation, was down 60 basis points to 13%, compared to ANZ's 11.7%. But there were a number of one-off items which impacted the cash earnings, which is their preferred measure, of $2.95 billion, which is up 0.4% from 2018 and 7.1% from the first half of 2018. Consumer banking dropped cash earnings by 20.6%, and customer remediation provisions stood at $1.11 billion, and they plan to have 500 people deployed in this activity. Overall income was higher thanks to volume, but offset by margin compression of $110 million, a fall in fees and commissions down $22 million, and a customer remediation charge of $340 million, to give a net lower income of $8.9 billion. Operating expenses were flattish, but the total full-time equivalent rose from 33,283 in the second half of 2018 to 33,790 in the first half of 2019. They said that the bank was midway through its 3-year transformation program, with additional investment targeting of $1.5 billion, and that cost savings and FTE reductions are broadly on track. The group net interest margin fell. Of course, NAB delayed their Australian mortgage book repricing, and clearly this cost. But corporate and institutional helped support the result. The subsequent mortgage repricing may help ahead. Home lending in Australia shows that approval rates have remained stable over the past 2 years, and that the reliance on household expenditure measures, or HEM, has fallen to 32% of loans in March 2019, compared with 41% of loans in September 2017. Net interest margin across Australian home loans fell 6 basis points from September 2018 to March 2019, and it continues the slide from 2017. Loan growth slowed, especially investor lending, and defaults are similar in both proprietary and broker channels now. NAB implemented comprehensive credit reporting, CCR, for mortgages in February 2019, and they were the first major bank to reach this milestone in Australia. Lending standards have become tighter. Income is now verified using a variety of documents, including payslips and/or checks on salary credits into customers' accounts, and they apply a minimum 20% shading on less certain income, for example, rental income, since 2015. Household expenditures use the greater of customers' declared living expenses, enhanced in 2016 to break down into granular subcategories, or household expenditure measure benchmarks, which has been in use since 2012 and was enhanced in 2015 to scale for customer income, and it was further refined in December 2018. From a serviceability assessment, customers' ability to pay is assessed based on the higher of the customer rate plus serviceability buffer at 2.25%, or the floor rate of 7.25%, with long-standing use of floor and updated in 2016. They also consider existing debt, and they verify that using declared loan statements and assess existing mortgage debt using a floor rate of 7.25% and a buffer over the customer rate of 2.25%. In December 2018, they tightened the assessment of customer credit cards, assuming repayments of 3.8% per month of the limit. And interest-only loans are assessed on the full remaining principal and interest term, and the term for owner-occupied borrowers is 5 years. They also have loan-to-value limits. So, for example, principal and interest owner-occupied loans are 95% limit, investors are at 90%, interest-only owner-occupied are at 80%, and high-risk postcodes, for example mining towns, are at 70%. And in 2017 they introduced loan-to-income decline thresholds, which had been at 8 times, down to 7 times in February 2018. And in April 2019 they introduced a debt-to-income decline threshold of 9 times. And lenders' mortgage insurance, LMI, is applicable for the majority of lending over 80% loan-to-value ratio, but LMI for inner-city investment housing is greater than 70% loan-to-value ratio, and the apartment size must be at least 50 square metres, which includes balconies and car parking. And finally, NAB broker applications are assessed centrally, including the verification and credit decisioning. Now, they also showed that loan-to-value bands still include loans above 80%, and the proportion are actually rising. And also defaults are rising, with 90-day plus defaults partly attributed to the conversion of interest-only loans to principal interest loans. And Western Australia has the highest levels, but other states also rose. And this is consistent with the results yesterday from the ANZ. Now, all of that tells me that whilst the proportion of loans being approved may be the same, the standards are now way tighter than they were, let's say, 2 or 3 years ago. And that means, firstly, that many households had loans they should never have got in the first place. And secondly, today, lending standards are way tighter. And I don't think that's going to change anytime soon. So people can talk about the Reserve Bank cutting interest rates, or indeed APRA reducing the 7.25% hurdle. But frankly, if the NAB is anything to go by, the new tighter standards are set to stay, and as a result of that, I'm still expecting credit to continue to be tight, and indeed the credit impulse to continue to go slower. Group credit impairments rose to 0.15% of GLAs, and the group provisions are higher, as are the specific provision balances. The CET1 ratio is 10.4, up from 10.2 in September 2018, and they said that they were on track to meet the unquestionably strong credit ratio target that APRA has imposed. And the liquidity ratio and the net funding ratio both remained strong. So in summary, the underlying franchise still actually looks in reasonable shape, but the weakening housing sector needs to be watched, and more broadly, this continues the trends of higher levels of mortgage defaults, which we believe will continue to deepen in the months ahead. Chickens, as they say, are coming home to roost. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.